Imagine you never cashed out to your bank, but tax season still says you may have a crypto tax event. That is the confusion this video untangles. Crypto taxes usually come down to one plain question. Did you simply hold an asset, or did something happen that your tax system treats as receiving value or disposing of value? Before we go further, this is education, not tax advice. Crypto tax rules vary by country, and your exact answer can depend on your residence, your business activity, and the details of each transaction. Crypto feels strange because one wallet can do many things. You can invest, trade, earn rewards, bridge assets, pay fees, use DeFi, and move coins between wallets, all without a bank statement explaining the tax story. Think of taxes as following two tracks. One track is about selling or swapping something you already own. The other track is about receiving something new, like rewards, payment, or yield. The first track is capital gains and losses. This usually starts when you dispose of a crypto asset. A disposal can mean selling it for cash, swapping it for another token, or spending it on something. The second track is income-like events. This usually starts when you receive crypto because you did something, provided something, or earned something. Staking rewards, mining rewards, airdrops, and crypto payments often live on this track. In many tax systems, buying crypto with ordinary money is not the moment that creates a gain. You have mostly changed the form of what you own. The important number begins there because it becomes your starting cost. That starting cost is often called cost basis. If you buy $1,000 of Bitcoin, your basis is generally around $1,000, plus certain fees, depending on local rules. Later, if you sell that Bitcoin for $1,300, the basic gain is the difference between what you got and your basis. In this simple example, that difference is $300. If you sell for $800 instead, the math points the other way. You may have a capital loss. How that loss can be used depends heavily on your local tax rules. Some countries also care how long you held the asset. In the United States, for example, capital gains are generally split between short-term and long-term based on whether the holding period is 1 year or less or more than 1 year. A common beginner mistake is thinking taxes only appear when cash touches a bank account. In many places, swapping one crypto asset for another can count as disposing of the first asset. Say you bought Ether, it increased in value, and then you swapped it for a governance token. You may feel like you are still in crypto, but tax rules may see you as selling Ether and buying something new. If this kind of plain English crypto education helps, consider subscribing. The goal here is not hype. It is understanding the moving parts before they surprise you later. Spending crypto can create the same issue. If you use appreciated crypto to buy a laptop, many systems treat it like you sold the crypto for the laptop's value, then use that value to buy the laptop. Moving coins between wallets you control is usually different from selling them. If you move Bitcoin from an exchange wallet to your hardware wallet, you've changed where it is stored, not who owns it. Even simple transfers can have details. If a network fee is paid in crypto, some tax systems may treat the fee itself as a small disposal. That is why records matter, even when the transfer feels routine. Now, let us look at staking. In proof-of-stake networks, users may lock or delegate coins to help secure the network. In return, they may receive new rewards over time. Staking rewards often look less like a capital gain at first and more like receiving new value. In many places, that reward can be treated as income when you receive it, or can control it. If a staking reward is taxed as income, that value often becomes the starting basis for those reward tokens. Later, when you sell or swap them, a second calculation may happen. Imagine you receive a staking reward worth $10. Later, you sell that same reward for $14. Depending on your rules, the first 10 may be income, and the extra 4 may be a gain. The hard part is timing. Some rewards appear automatically, some are claimable, some are locked for a while. Some arrive through an exchange program. Those details can change how a professional analyzes them. Not every product called staking is the same. A custodial platform may offer an earn program that feels like staking to the user, but the legal and tax treatment may depend on what the platform is actually doing. Stablecoins create another beginner trap. Because one stablecoin often aims to stay near $1, people assume stablecoin trades do not matter for taxes. That assumption can be wrong. In many tax systems, a stablecoin is still a digital asset, not just invisible cash. If you trade Bitcoin into a dollar stablecoin, the outgoing Bitcoin may have been disposed of. Stablecoin to cash may also have small gains or losses. If the stablecoin was bought, redeemed, traded, or used at slightly different values, the math may not be exactly zero. For small personal transactions, stablecoin gains may be tiny, but frequent traders, businesses, DeFi users, and people moving large amounts can create many lines of records from stablecoin activity alone. DeFi can add more layers. Supplying liquidity, receiving pool tokens, borrowing, lending, and harvesting rewards can all change what you own or what you receive. The tax question is what actually moved. A useful habit is to follow the asset. Did your original token leave your ownership? Did you receive a different token? Did you earn a reward? Did a fee spend part of your balance? The blockchain records wallet activity, but it does not always explain tax meaning. It may show an address sending tokens, but it does not know if that address was yours, an exchange deposit, a gift, or a payment. Exchanges may provide tax forms, statements, or transaction exports. These can help, but they may not know your full history if you moved assets from another exchange, a private wallet, or a DeFi protocol. The biggest record problem is missing basis. If a platform sees you sell a token, but does not know what you originally paid for it, the game calculation can be incomplete or misleading. Good records usually include the date, time, asset, quantity, value in your local currency, fees, wallet or exchange, and the reason for the transaction. The reason is often what turns raw data into tax meaning. Most tax systems want values reported in the local currency. That means crypto transactions usually need a fair market value at the time of the event, even if the transaction happened entirely on-chain. Rules vary because countries classify crypto differently. One country may emphasize property rules. Another may have special rules for private sales, business activity, mining, staking, or foreign reporting. The same action can have different results in different places. Selling Bitcoin, earning staking rewards, gifting crypto, or using stablecoins in a business may be treated differently depending on where you are taxable. Misunderstanding 1 is thinking no bank cash out means no tax event. In many places, swaps, spending, and other disposals can matter before money reaches your bank. Misunderstanding 2 is thinking a stablecoin is always tax neutral. Stablecoins may reduce price volatility, but they do not automatically erase the tax history of the asset you traded into them. Misunderstanding 3 is treating rewards like free coins with no paperwork. Rewards can create income questions when received, and then gain or loss questions when later sold or swapped. Misunderstanding 4 is trusting screenshots alone. Screenshots can help, but a full transaction export, wallet history, and clear notes usually tell a much stronger story. Professional help becomes especially important if you used DeFi, traded often, ran a business, received rewards, moved assets across countries, lost access to funds, or have incomplete records. Here is the clean recap. Holding is usually different from disposing. Selling, swapping, or spending can create gains or losses. Rewards can look like income. Stablecoins still need records, and local rules decide the final treatment. If one part of crypto taxes still feels confusing, leave a question in the comments. You can also suggest the next topic, like DeFi taxes, NFT taxes, wallet tracking, or how crypto tax software works.